Welcome to this video. Today we need to talk about Adobe. Adobe crashed over 60% from all-time highs, and the question is whether this company is still the king of high switching costs. So in this video we're going to go over the latest news, the fundamentals and technicals, and we're going to find out whether today could be a potential stock bottom or whether the panic is justified. So buckle up and let's dive right in. We're now here on TradingView. We're looking at Adobe and it's now trading at $248. And we can see that in the last over 10 years, it's done really well. Like there was a strong uptrend. It went higher. But in the last 8 years, it didn't really do well. So the stock price is basically the same as roughly 8 years ago, which could suggest that the company is really undervalued or there is real problems within the business. Well, if we look here at daily candles, we can see, for example, that the downtrend is still intact, but it's on the lower side. And last Friday, it closed with a green bullish candle, which could suggest a potential bottom if we just look at the technical analysis by itself. But we also have to look at the fundamentals of the company and the current position of Adobe in the market. And then at the end of the video, we'll come back to the charts to make a prediction based on probabilities whether this could be a stock bottom for Adobe. So what exactly is Adobe? Adobe is a software company that helps creative people make content. And they do it through video editing software like Adobe Premiere Pro or Photoshop and many other apps that they have. And they now also have AI image generation apps to help people create. And Adobe has always been the industry standard. So how do they make money? Well, you can see that they sell subscription models, and everything is a subscription model. And that's why they have this recurring income, which gives them a lot of stability. And they sell to individuals like to you and me, but they also license to other businesses. And that gives a lot of recurring income as well. And also students and teachers, they get discounted. And you have schools and universities. So everything is recurring income for Adobe, which has been a very good business model for a very long time. So here we can see all the apps they have. So they have a lot of different applications. For example, Photoshop, the Adobe Firefly, Adobe Premiere, that's for video editing, AI Illustrator, After Effects, Adobe Express Premium. So they have many different apps for you to do creative work. So what is the problem with Adobe? Why has the stock crashed over 60% and why is the stock price so low? Well, it's because of the fear of AI, the fear of the threat of AI. We are now in the middle of the AI boom and everything is becoming AI and the demand for AI increases exponentially, which we can see, for example, in this graph. We can see the search term AI on Google Trends, and we can see that after 2022, it went just exponential and it's still growing today. In short, many investors are scared of AI and that's what they're selling their Adobe. But is this threat real? The fear is AI. And what does AI do? Well, companies like Canva are implementing AI and they offer similar services, but then for much lower prices or almost free. You also have free versions. And these creative design software applications become much more affordable for normal individuals. And that is the biggest threat because Adobe is quite expensive. And you have also companies like CapCut for video editing software. And most of the features are essentially free. And that is very hard to compete for Adobe. So investors are scared. And that's why they're selling their shares because they think in the future everything will be free and Adobe cannot make money anymore. I think that the majority of people are still using Adobe, especially the professionals, because it has more features and it's still the industry standard. And it's not so easy to compete with. And here we can see that they're also implementing AI as well. So they're not like a dinosaurs because a lot of investors have this, Adobe is like this dinosaur, they're very old school, but they are implementing AI as well. So Adobe is amplifying human ingenuity with AI, helping customers enhance their creativity, increase their productivity, and deliver more personalized experiences. So they're very busy with AI. And if we look here at the timeline, we can see that they were very aware of this development. And they were actually pretty early. So in 2016, Adobe Sensei enables the development of AI-powered features across Adobe's product portfolio. So since 2016, they were thinking about AI and making it possible, and now they have Adobe Firefly. We're now looking here on the investor relation page of Adobe, and we can see here the latest news. And what we can read here is that Adobe and NVIDIA are working together. So NVIDIA is one of the largest companies in the world, and they're on the forefront of AI, especially when it comes to the hardware and the infrastructure. So working together, partnering with NVIDIA is a very smart move for Adobe, and this will keep their high switching cost intact. So we can read here, Adobe and NVIDIA announced strategic partnership to deliver the next generation of Firefly models and creative marketing and agentic workflows. And we can see here that Adobe will use NVIDIA's advanced computing technology and libraries to deliver the next generation of foundational Adobe Firefly models. So by working together with NVIDIA, they will stay ahead of the competition and they will have the latest technology available. So here we can see that the key areas of the strategic partnership include the delivery of the next generation of Adobe Firefly models, so to create like these images, Adobe agentic AI innovation, and many other things. And this is great news. And this is one of the most critical moves that Adobe has recently made to keep the company alive. To get like a quick financial overview of the company, we can look here on Guru Focus and we can see that they gave it a score 88 out of 100. And if we look here down, we can see that the financial strength is an 8 out of 10. They don't have too much debt. And they're very profitable. So every quarter they have positive net income, and this is great. So this isn't a losing business. So their recurring income is still very strong. And here we can see this is like a perfect picture of a great company. We can see revenue increasing every year, and we can see the net income increasing every year as well. And we can see that the cash and debt levels are pretty much intact, which means that the debt is not too much higher than the cash. And this is great. This is very healthy. We can see in the income breakdown that the net income is over 30% in 2025, which shows that their margins are pretty good. If we look at the latest quarters, we can see that in quarter 2 2024, for example, is plus 21%, plus 20%, but here in quarter 1 2026, plus 4%. So the earnings are growing every quarter, and they're still growing today, which shows that the effect of AI hasn't negatively impacted Adobe yet. Are you ready to master stock analysis yourself? Well, I built a step-by-step video guide to help you build a winning portfolio that does well over time. So if you want to stop guessing and start winning, then make sure to check the link in the description below. Adobe stock price collapsed over 60% from all-time highs, but the question remains, is it now super undervalued? Is it super cheap? And do we have a margin of safety? Let's find out. The first metric we're going to look at whether a company is cheap or expensive is the PE ratio, the price to earnings ratio. A lower price to earnings ratio shows that the company could be undervalued if the growth is still the same. So here we can see that the PE ratio at the bar below, it's now at roughly 14 and the stock price is 248, which shows that it's all-time lows. It's never been this low in the last 10 years, which shows that the company is undervalued based on PE ratio. If we look here on Finviz, we can see that the P ratio here at 14.46, which is in green, which shows that's cheap, and the PEG ratio is 0.77. So PEG ratio is price to earnings to growth, and if it's below 1, it also is an indication of a undervalued company. To get a more in-depth like intrinsic value of the company, we can use a discounted cash flow model based on the Warren Buffett's owner earnings, and that's basically the earnings that's left for the stockholder. So we can discount all future cash flow to present value to find out how much this company is actually worth and whether it's cheap compared to the stock price. So I filled in all the numbers. You can find everything on TradingView, and we can use for the growth rate like 10%. For example, here on Finviz, they expect the earnings to grow for the next 5 years for 12%. And here on Seeking Alpha, we can see it's like 13%. So let's be conservative and round it lower to 10%. We can calculate the intrinsic value. We're going to use a discount rate of 8%. And we can find out that it's very undervalued by 48%, potential upside of 93%. So the true value per share is roughly $474 if we use a conservative measure. So based on this calculator, the company is very undervalued, and the true value per share is around $474. So our true value per share was around $474 per share. But if we look at like other opinions of different website, like for example, Alpha Spread, they also do a discounted cash flow value, and they find a intrinsic value of $444, which is pretty similar. So they say it's undervalued by 44%. And in the worst case scenario, it's still undervalued by 28%. And if you look here at Guru Focus, for example, that you can also see that they say it's significantly undervalued, and they say that the true value per share is roughly around $600, which shows that they even say it's more undervalued. So it doesn't matter which metric we use, which calculation we use, or which website we look at. Everyone kind of agrees that the company at the moment is very undervalued based on intrinsic value calculations. Before we invest into Adobe, we need to know whether it still has a strong wide economic moat. So what's an economic moat? An economic moat is the competitive advantage belonging to a particular business that protects its profit margins from competitors in the market and other external threats. So this theory is popularized by Warren Buffett himself, and an economic moat consists of network effects, switching costs, economies of scale, and intangible assets. To find the economic moat of the company, I made an economic moat analyzer on Investing Sprint, and we can find it here, and we can type in Adobe. So Adobe, and we can analyze the moat, and then we can find that Adobe has a wide moat, which is great. So Adobe has built a wide moat through its creative software suite that has become the industry standard with extremely high switching costs for professionals and business embedded in its workflows. So the overall moat score is an 8 out of 10, where the switching cost is a 5 out of 5. And this company is used in every example explaining what an economic moat is, because it's very difficult and expensive for customers to switch to a competitor, for example. So what are the strengths? Well, it's the industry standard creative software, very high switching costs for professionals. Once you're locked into the system and you have spent many years learning how the software works, you don't want to switch to another software, because that will be much more costly for you, because you're already used to the software and it has all the features that you want. So they also have like successful transition to SaaS model, growing digital experience segment. They also have implement AI right now, which is great. The risks, competition from lower cost alternative. We talked about this before. CapCut, like Canva. Economic downturn, reducing creative professional spending. If there is an economic a crisis, then people are spending less, of course. But I don't think this is too much of a risk. Cybersecurity risk, I don't think this is too high as well. And potential regulatory scrutiny of market position, also not a massive risk. So here are the strength and risk, and I think that the moat is still intact and it's still a wide moat company. And we see this in the earnings that they are still strong. So for now, I don't think that this company is in too much trouble. So we're now back here on the chart and we're looking at Adobe on monthly candles, and we can see that it's finding support here at the 200 simple moving average. And we calculate that the intrinsic value was roughly at around $474. I think this is like a very conservative value. I think the true value could be much higher than that. And they have also a lot of growth potential because they are really innovating when it comes to AI as well. So I think that this could be a potential bottom. I think it's very likely that's going to bounce from here up. Maybe we can go to the 200 simple moving average or a little bit below, but then we will see higher highs in the future. That's at least what the most likely outcome is based on the research I've done. But of course, always do your own research, always do your own due diligence. This video is just for educational purpose only. But if you like this kind of content, feel free to like and subscribe. And if you want to support this channel even more, feel free to become a member or check the link in the description down below if you want to learn how to master stock analysis yourself. With that being said, I hope you have a great day and I'll see you in the next video.